whenever there's a strong breakout like here down, you usually get some kind of a measured move from it. And normally the measured move is in the direction of the breakout. But about 40% of the time, you get a reversal and you get the measured move in the opposite direction. We had that very strong trend up on a couple days ago on Tuesday, closing on its high. It's a reasonable buy the close bar, although who's going to buy the close at the end of the day? But because it's reasonable, bulls who buy more lower, like above a bull bar here or here, have a, I don't know, 70% chance of making money. So I think we're going up to Tuesday's close either today or tomorrow. We may get a second leg down. It might be leg one, sideways, leg two. But right now I think we're going at least a little bit higher. We're in a seasonally bullish time of the year. Last week of August into September 5th tends to be bullish. One problem the bulls have is on the daily chart. Yes, the bulls get a good reversal up from both a high two, leg one, pullback leg two, and a wedge, 1, 2, 3. Very good reversal up on Tuesday. But yesterday was a deep pullback, bad for the bulls, and a weak buy signal bar, a doji. So while I think we're going to get up to Tuesday's high, and the next day or two or three, this doji plus the deep pullback increase the chances that we might go sideways for another day or two before the bulls try to test higher. We're still in a bear channel. I still think it's slightly more likely that we're going below this low before we get above that high. And you can see where we are right now. Pretty much in the middle of the two targets. And we may go sideways in the middle for another day or so before the market decides whether to test up here or break below here. Because this is a wedge, bull flag, you always have to be thinking about the possibility of a bear breakout below the wedge. A bear breakout below the wedge has a better chance of leading to a measured move down if the wedge first reverses up for a few bars, which it has done. So by going up here, that means more bulls are positioned long with a stop below here. If we break below here, that would increase the chances that we'll fall for a measured move down. The bears see this as a bear channel, and their stop is above the most recent major lower high, which is here. And the bulls want to break above here. If it just goes a few ticks or a couple points above, it could still be a double top lower high major trend reversal. Bull trend, bear breakout, and then double top. The bulls needed to break strongly above this high. Even if the bulls do get their new high, this is still probably going to be a final bull flag. Weekly chart, a 20 gap buy setup. We've been above the moving average for 40 bars, and the bulls have been buying above it an average price for 40 bars. Now they finally get a chance to buy at the average price. However, because this is so extreme, I think the odds are we'll need more than a 3-bar correction before the market can go higher. If it does go higher from here, it probably will fail above that high, and we've probably begun a trading range that'll last several months. I keep going, comparing it to 2003 over here, where the market was above the moving average for 50 weeks. It did not hit here or here, and this is what happened. A 20 gap bar buy, good rally, sideways, rallied again, sideways. It stayed sideways for about 10 months. I don't know that we stay sideways for 10 months, but I think we're probably going to be sideways for several months. Big reversal up. If the bulls get a bull bar here, especially a close above 74, then we're always in long. I said yesterday after this ledge that we probably would get above the ledge either the same day or the next day. Okay, and we just went above it now. And that means the market will next try to go for the resistance up here, the close from 2 days ago and the high from 2 days ago. Bear trend, lower low, higher low, major trend reversal, bull breakout, and then a double bottom, trying to break above the double bottom. It's also a double top. We're trying to break above it, go up for a measured move. We're getting pretty close to that trend line. 15-minute chart, here's the trend line. And this is the real price, that major lower high. the bulls want to get above it and the bears want it to stall. This is a seasonally bullish time of the year, end of August through September 5th, and that means there's a tendency for the market to go up, and that increases the chances that we'll get up here and test that lower high. Not a very good looking buy signal bar. I think always in long. For the bears, they want the failed breakout and reversal down. Because it's not a great looking buy, it's probably better to wait a bar or two to see what we get. Now, what happened the past 2 days? Two big bull bars on the open low of the day. Yesterday, one big bull bar but a second bull bar low of the day. And so two big bull bars and then a doji and a bull bar, and now a smaller doji and trying to get a bull bar. This led to a strong rally. This led to a weak rally in a trading range, and this is weaker still. First bar, big bull bar, second bar, a bull doji, and then third bar today, a simple doji. So while the bulls are trying to replicate what they've done the past 2 days, the setup is getting a little bit weaker. The first bar here, very strong bar. Second bar, bull bar, but doji. And then today, the bulls could not even get a bull bar on that first bar. So, and you can see yesterday was a weaker rally off that weaker buy setup. And today's probably going to be weaker still. So I would wait to buy. Because on the daily chart, we had a deep pullback after the strong reversal. That reduces the chances that we'll go straight up. Also, we had a doji bar yesterday. That reduces the chances that we go straight up. Not a very good looking buy signal bar on the daily chart. Plus, a big enough down move that we probably have to go sideways for another day or two before we try to go up. You can see, unlike the past 2 days where bar 2 is a big bull bar, the traders are not buying above bar 1. The bar 1 was weaker yesterday, and it's even weaker still today. Can you sell below 1? Failed breakout yesterday's high. Well, just like there were sellers above, there might be buyers below, especially around the moving average, which is about a point below. If it closes on its low, that would be a decent 10-minute sell signal. Here's a 10-minute chart. So if it closes on its low, a decent sell signal bar for a failed breakout above a double top. Yesterday, small range. Whenever you have a small range and you're breaking above its high, there's a higher probability that we'll get all the way below its low. And so when you have a small doji day like yesterday, the next day, higher probability of an outside day where it goes above the high of the day and then below the low of the day. So while I'm bullish over the next several days, right now I think we may go sideways for another couple of days. Just like bar 1 was the low of the day for the past 2 days, the bears want bar 1 or bar 2 now to be the high of the day. So possibly leg 1 and then sideways and then leg 2. That's what the bears want. You can see as soon as 2 closed, they sold it, but we're right at the moving average. And the bulls are hoping for an opening reversal up from the moving average. The bears are hoping for a failed breakout yesterday's high. That first bar, being a doji, increases the chances of sideways. Yesterday, being a trading range day, increases the chances of being sideways. You can see the bulls tried to get an opening reversal up from the moving average, and so far not looking good. I think yesterday's gap down damaged the bull case, and it probably means the market has to go sideways for another day or two before the bulls will try to get a resumption up. And with yesterday being a small day, and the market reversing from above its high, there's an increased chance today will be an inside day. So it might be second leg down, 1, sideways, 2. Back to the 60-minute moving average, getting near yesterday's close, near yesterday's low. Probably always in short if this bar closes in its lower half, but not a great location to be selling, right at the 60-minute moving average. I'm typing the morning update. Anyway, so the bears want a failed breakout yesterday's high, and then a big bear trend day, not likely. The bulls want the sell-off to reverse up from support, 60-minute moving average, and create an opening reversal up and an early low of the day. Today's probably going to be another trading range day. We've had a big sell-off on the daily chart, a big reversal up, and then a big gap down yesterday, and then yesterday was neutral, trading range day. So a lot of confusion. Big down, big up, and then big down again, and then sideways. That means the market's confused, and that usually means a lot of trading range trading, and that increases the chances that today, like yesterday, will be mostly a trading range day. Even if we do reverse from above yesterday's high to below yesterday's low. And for the bulls, like I said, they want an opening reversal up. Right now we're always in short, but not a lot of traders willing to sell at the bottom of yesterday's range at the 60-minute moving average. We traded 5 ticks above yesterday's high. It's fairly common if a day becomes an outside day that the break below the low is about the same size as the break above the high, and therefore probably buyers about 5 ticks below yesterday's low if we get there. Those 2 good bear bars, 2 and 3, are the opposite of the 2 good bull bars over here. When you get a pair of good bars like that, you get about a 60% chance of a measured move in the direction. So here, 60% chance measured move up. Here, 60% chance measured move down. Might be a little bit less because we're at the 60-minute moving average, but that is the measured move target. Globex market, spike, pullback, channel, spike, 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 nested spike and channel. This is the first pullback after the initial spike, so we're at a buy zone, a location where a lot of the bears will take profits. When you have a spike pullback channel, the market tends to come down to the bottom of the channel, and then buyers come in. So we're in a buy zone, but we have pretty good momentum down. Can the bulls prevent this from being an outside down day? Yeah, I mean, it's a sell vacuum test of yesterday's low. And sometimes when you have an attempt to go outside down, the market reverses up right above yesterday's low. So you'll have bulls buying in this general area. Right now the momentum down is strong enough to make an outside down day likely, but on the daily chart, that doji bar yesterday, big bull bar the day before, that makes a big bear trend day unlikely. Anyway, here, right, the bulls reversed up from below yesterday's low, but could not get above yesterday's high. So a lot of times you'll get the reversal and it does not go outside. That's fairly common. Here we opened above yesterday's high, sold off, could not get below yesterday's low, and then rallied back up. And that's what the bulls are hoping will happen today. Pretty good break below the 60-minute moving average. Remember, I still think the odds are the daily chart is in a bear trend, even though everyone on television on Tuesday was making it sound like it's still in a bull trend. It is in a bull trend, but it's also in a bear trend. We have higher low in a bull trend, so it's still in a bull trend, but I also think it's in a bear trend, and I think the bear trend is more likely to continue, and I think the bull trend will fail. The bulls need to get above this lower high, and I said that with this reversal up, we could go up for a few days, trapping bulls into longs. And then if we break below this, that would have an increased probability, like a 60% chance of a measured move down. Right now, I still think we'll go sideways, maybe up a little bit over the next few days, but the bears are trying hard to get the resumption down. Here's the daily chart. And the reason why I think that it's more likely that the bears will win and the bear trend will continue and the bull trend will fail is because the weekly chart is so extremely overbought. I mean, this is so unusually overbought. It limits, I think, the upside from here. Right now we have a bull bar on the daily chart. The week has not closed. We still have tomorrow. There's still a small chance we could get all the way down below the open of the week. Here's the open of the week right here. Whenever you get these sell-offs like this on the open, that could lead to opening reversals. They always look so strong that you think it's just no way we can reverse up. But it happens. It happens often enough so that, the math is actually okay to buy at the market here and put a stop below yesterday's low. Why is the math okay? Well, you're risking 2 points and you're betting we'll get back up to the high of the day. So you're trying to make maybe 8 points, risking 2 points, and you might have about a 30% chance. Higher probability to wait to see if we reverse up. You get a very strong sell-off on the open, and then a reversal day. Strong sell-off, reversal. Strong sell-off, reversed up, reversed up, reversed up. This is incredibly strong. Couple legs down, 3 legs down, reversed up. Three legs down, reversed up. I have to say today, this sell-off is strong enough so that we'll probably have to get another leg down. On a smaller time frame chart, you could say, well, we went down on 1, we went up on 1. We went down on 3, up on 4, and down on 5, and then tail. So on a smaller time frame chart, this is a parabolic wedge. Let me put up a 2-minute chart. So up, 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 or up, up, up. But 5-minute chart, not convincing. And therefore, the bulls will probably need at least a small double bottom. Right now I think it's more likely that we're, probably 70% chance in this minute that we're going to go outside down. But we may bounce before we go outside down. And like I said, I think the odds of a big bear day are not very big. I think it's going to be mostly a trailing range day. For the bears, leg 1, pull back, and then leg 2. If it falls for a leg 1, leg 2 measured move, there's leg 1. This would be the start of leg 2, and that would be the leg 1, leg 2 measured move. Okay, outside down. Some buyers yesterday's low, betting that yesterday's a doji bar, and therefore a weak buy signal bar. We traded above yesterday's high, did not go up. And it's also a weak sell signal bar, and therefore trading below yesterday's low, probably not going down all that far. Context good for a reversal day. but the bulls do not yet have a credible bottom. Still sell the close. Look at the open and high of 6 compared to the close of 5. Right. So as soon as the bar is closing, they're selling. But I would not sell down here. We hit the target. The target was yesterday's low. And you'll have bulls taking profits and, bulls buying for a scalp and bears taking profits. Strong enough down, first reversal up probably will be limited, and probably the bulls will need at least a micro double bottom. So even if we go up, we'll still probably have to test back down here. Sometimes you get a really abrupt reversal like this, and the test down does not get all that far. And the bulls who sold this close had to sell more below a bear bar, and it came back to below the midpoint of their 2 sells, and they could avoid a loss, which is usually the case, and that'll probably be the same today. So even if we reverse up strongly, we'll probably come down to the midpoint between this close and the low of a bull bar up here. So bears selling, either the close of 6 above 7, probably will be able to avoid a loss or make money. And for the bulls buying here, they know the sell-off is strong enough so that the bears will probably get at least a small second leg down, even if we go higher. Therefore, the bulls are mostly scalping. You can see we went 6 ticks above yesterday's low, and the bulls took their profits. The bulls scalped. For the bears, 7 is a low one short, a pullback from the breakout below yesterday's low. But, we went 5 ticks above yesterday's high. We may not go much further below yesterday's low. So not a strong stop entry sell below 7. Let's say 7 is a big bull bar closing on its high. Possible low of the day. It would discourage bears from selling above 7. Some bulls might buy, but even if the bulls buy, they know the odds are it'll not go straight up. The odds are, even if we get the reversal, like here, we'll probably have to test down. We test down to a lower low here. Even if you get the reversal up, you still have to test back down. Huge reversal up, but still tested back down. Here we stair step down. You still get a micro double bottom at the low before the reversal up. Now I've been talking reversal day, right, during the sell-off because it's more likely than a big bear trend day. But because I think this looks like a continuation of the correction from this rally, we might get a leg 1, leg 2, leg 1, pullback, leg 2, and we might have to come all the way down here before the bulls buy again. What do you do with the 7 high? I would not buy. All right, I think the sell to close bears 6 will either make money or be able to avoid a loss. So I think it's more likely that there are sellers above 7. I would wait to see if we get maybe 3 consecutive bull bars or some kind of a double bottom before buying. Bulls trying hard to make a statement. They want 7 to close on its high. And bears don't want that, but the bears were not strong enough to stop it. Whenever there's a strong bear trend on the open and then you get a bull bar, it's usually better not to sell that high because the reversal up can be very big. And the opposite is true if there's a very strong rally on the open and then a bear bar, because you can get a really deep reversal. Here, not a great buy below 3. This was so exceptionally strong, I thought we were going up, and plus the bear bar is not all that big. But this kind of a thing, you got to be really careful of strong bull reversals followed by bear bars. This is a bear trend, so it's better math for the bears. I'm looking for a trading range environment. I'm not really finding what I'm looking for. Coming into today, the odds favored a trading range day. I still think the odds favor a trading range day, even though we're now always in short. If it's going to be a trading range day, then that means I'm talking about a reversal day. So you get an early sell-off and then a bull channel for the rest of the day. So reversal day goes down, reverses up. Does not become a big bull trend day, even though it rallies for hours afterwards. Big sell-off, reversed up, did not become a big bull trend day. Reversed up, did not become a big bull trend day, could not get far above the open. Could not get far above the open. If the initial sell-off is small, you can get a reversal day that becomes a big bull trend day. But if the initial sell-off is big, usually the best the bulls can get is a rally up near the prior day's high. The minimum the bulls wanted was a micro double bottom. If we reverse up on 8, that would be the micro double bottom. To me, it looks like we're going to try to get down to that leg 1, leg 2 target. 60-minute chart, trying to test that low again. 60-minute chart, leg 1 down is here, and then leg 2 down would be here, which is around Tuesday's low. Bulls probably buying 6 low, 7 low. Not a good sell signal bar and not good context. We're at the bottom of a trading range. If the bulls get a decent bull bar here, if 9 looks like 7, that would be a second failed breakout of yesterday's low and a reasonable buy for a swing up, possible low of the day. When you get reversal days, they usually do not go up violently. They usually go up in like a channel, a weak rally. You can see pullback, pullback, pullback. Here it took 3 legs down before the bulls got their reversal. Here sold off, 50% pullback, and then sold off again. This channel is a little tight. That makes the higher low major trend reversal less likely. Usually when you have a tight channel, you have to test down a second time. The bears know that the bulls want a good buy signal bar, so the bears are trying to stop it. Remember I said yesterday that after 9 consecutive bull bars, the market probably would go sideways instead of back up. I still think sideways and then a test back up is more likely than a big reversal down. But I still think we're in a bear trend on the daily chart and that we're going to correct down to the 2350 area over the next couple of months. Reversal up on 7, big tail on 5, big tail on 8. Bears not pressing their bets and selling at the lows. They're buying at the lows, and the bulls are buying as well. Bull scalpers made money buying at yesterday's low, and then again below 7. A lot of the bears are hesitant to sell down here because of these reversals. To buy above 9, a lot of the bulls will want 9 to close on its high or near its high. Otherwise, a lot of the bulls will wait. 15-minute Globex chart, we're in the buy zone. We pulled back to the bottom of the channel. We even pulled back to below the bottom of the entire leg. Expanding triangle, down, up, down, strongly down, unlikely to go straight up. Even the 15-minute chart will probably need at least a micro-double bottom. For the bulls, this is a pullback from the breakout above this bull flag. And for the bears, it's a double top bear flag neckline. They want a measured move down. A lot of reversals here. Up on 5, up on 7, up on 8, up on 9. So confusion. Important bar. If it closes on its high, bulls will probably buy, taking a chance on a swing up and the low of the day. Can it close on its high and then continue down? Of course, we're still always in short, and that means it's still slightly more likely that even if 9 is perfect, it's still slightly more likely that we'll go lower. But if we reverse up strongly, then the probability shifts in favor of the bulls. Okay, reasonable swing buy, second failed breakout yesterday's low, but not yet high probability. Bulls need reversal up and then 2 or 3 bull bars before traders believe that the market's always in long. Similar to this, tried to bottom, failed, got a little bit more down, and then this bottom succeeded. Parabolic wedge. The one thing I would not do is sell the 9 high. All right, I would get out of shorts, and I think it's okay to buy. It's also okay to wait to see if we start to reverse up and then buy after you see the reversal, but I would not sell the 9 high. And I would not sell the 10 low, even though it's a small double top bear flag with 8. When the channel is tight like that, the reversal is still probably minor, which means that the bulls will probably still need at least some kind of a pullback. Tight channel, reversal up, initially minor. This is a higher low major trend reversal. This is a better, more convincing higher low major trend reversal. But even a minor reversal can go up a long way. I want, for a higher low major trend reversal, I usually want the pullback to be at least a third of the way down. And this is probably not a third. This is probably a third of that entire rally. So to me, this would be the higher low major trend reversal, not that. Looks like a lot of bulls scalped part. If it's a minor reversal, when can the bears sell? I'm not willing to sell yet. This is a big enough reversal. A lot of the bears will want at least a micro double top before selling. micro double top after the reversal. We have a micro double top here, but I would want a micro double top with this being the first top and then the second top before thinking about selling again. Good context, second failed breakout yesterday's low, good buy signal bar, and good entry bar. Bulls probably need one more bull bar to make it always in long. Ten ticks above 9, so you have some bulls scalping for 2 points. $60-minute bar closes in 7 minutes. The bulls wanted to close above yesterday's low, above the 60-minute moving average. And above a 50% pullback. It's unlikely that the bulls will get all the way back up to the open of the day. Sometimes when you have an outside day like this, it goes outside again. So it goes outside down and then closes back above yesterday's high. That's certainly what the bulls will try to do today. Here's an example of the opposite. We traded below yesterday's low, above yesterday's high, and then reversed back below yesterday's low. So it was outside up, and then it ended up outside down. Same thing, below yesterday's low, above yesterday's high, and then all the way back below yesterday's low, reversal. So today I'm talking about the opposite, where we trade above yesterday's high, reverse up from yesterday's low, and get back above yesterday's high. I think if this bar closes right here, okay, I think we're always in long. So probably 70% chance the first reversal down, bulls will buy it. So buyers below 11. Some hesitation, the bars are not big, 10, 11. Tails on top, 50% pullback, and at the 60-minute moving average, it was support. Now theoretically it's resistance. What are the chances that we get all the way back up above yesterday's high? At this minute, probably 30% chance. After bar 7, 50% chance we've seen either the low or high of the day. You can see traders are buying. You see how little overlap there is after the close of 9, close of 10, close of 11. So traders are buying on the close of the bars. Now I said that minor reversal, so we'll probably get a pullback. Where can you sell? Well, I think we went always in long, so it's probably not worth selling yet. When you get reversal days, usually there are pullbacks. Even if the day continues up for the rest of the day, you have to expect pullbacks. Here the pullback was small, but the bulls did take some profits. This is unusual to have such a small pullback after such a big channel. More likely we're going to get something bigger. So do you think the fundamentals became very bearish and then very bullish? No, it's nothing to do with fundamentals. It's purely technical. We had an extremely big rally the other day, reversing a lot of this, but this channel was tight and the odds were we'd go sideways to down for a bit. This was so strongly up, odds were that we would go sideways, might get 2 legs down, 1 pull back 2. So it's all about support, testing support and resistance. The reason why bulls are willing to buy, even though they know there'll probably be a pullback, is that they believe the reversal up is strong enough so that the best the bears get is a deep pullback, but they expect it to hold above the low and test back up. So they're willing to buy at the high, thinking that even if we pull back down here, they can buy more, expecting it to come up here again. That's the 60-minute close, and you can see there's the high of the first hour and the low of the first hour, and we were chased about half of the sell-off. All 3 moving averages close together. This is a reasonable area for the market to go sideways for a few bars. No top yet, but I think a lot of bulls will now wait to buy a pullback instead of continuing to buy closes. But, it's really interesting. 12 low is at the 11 close, 13 low at the 12 close. So bulls are still hitting the button. As soon as the bar closes, they're hitting by the market. Should go sideways here. All 3 average prices are very close to one another. That tells you that all 3 time frames, 5-minute, 15-minute, 60-minute chart, are balanced between the bulls and the bears. Despite the gap up, the reversal down, the reversal up. 16 ticks above 9. A lot of the bulls will get out of their remaining position at 4 points, so we'll probably go at least 1 tick higher, 17 or 18 ticks. I suspect that a lot of the bulls will either get totally out or mostly out and then look to buy a pullback. Usually if it goes 16 ticks, 90% chance if it goes 16, it's going to go 17 or 18, or 16 ticks above the buy signal bar high. So it'll probably go at least a little bit higher. Remember how bearish it was over here? And I said that today could be a reversal day. When you look at that, it says there's no way it's going back up. But the context was good for a reversal day. Yesterday's a trading range day. Today, a strong sell-off on the open. Right now, we're probably going to get above yesterday's high before the end of the day. I don't know that it'll become a big bull day, but coming into the day, I thought today would be a trading range day. I still think it's probably going to be a trading range day. When you get a big sell-off like that and then a reversal day, usually the market does not break strongly above the high and become a big bull trend day. Usually it'll be sideways to up for the rest of the day. So bear trend unlikely, but big bull trend from here also unlikely. More likely this kind of thing. If you get a deep pullback, you still tend to go sideways to up, even with pullbacks. Even with the pullbacks, deep pullback, you still go sideways to up. 13, surprise. So a lot of the bears, even though it's a buy climax, a lot of the bears will wait for at least a micro double top. But 3 moving averages close to one another, magnet. So probably we'll start to pull back here or soon. Target all the moving averages and the bottom of the most recent buy climax, 13 low. What are the chances that we reach a new low in the day? Right now, I would say 20%. So 80% chance we've seen the low of the day. Can the bears sell and put a stop above yesterday's high and scale in higher? I think we're probably going to get a pullback soon, but I think it's better to be looking to buy the pullback than to sell at the market or sell higher. Pullback possibly to the buy climax low and the 60-minute moving average. Where do the bulls start to buy? They'll buy anywhere, right? Chances are, right now, we're going to go sideways to down to the two moving averages and the 13 low at some point, but we're still clearly always in long. Traders, can you still buy the close? Absolutely, but you still need a wide stop. So your stop is way down here. If you're buying up here, you need to stop down here, and it's better to do it only if you can trade small and can scale in on a pullback. We might get a deep pullback. Look at here, right? So we could get big legs. Here the legs were 4 or 5 points. We could easily pull back, down to just below the 60-minute moving average. Can you buy the high one? Well, it's a buy climax here, and we're near resistance, yesterday's high. Buying a high one after a buy climax near resistance is usually not a very good buy. Probably sellers not far above 15 or 14. Unlikely to go immediately all the way back above yesterday's high. More likely we'll have to pull back first. So bears will sell somewhere, either here, or somewhere up here. But, I think it's a harder thing to do because the momentum up is good, and it's natural to feel nervous if it starts to race up. So if you're selling in a strong rally, you don't know where the top of the rally will be. You really need a wide stop. Minimum stop just above yesterday's high. If you get stopped out, then you sell more on the reversal down. Better to be looking to buy somewhere down here. Whenever you get a big bar, you're always going to be thinking about exhaustion gap or measuring gap. I think it's probably going to be an exhaustion gap. Measuring gap would take us up here, just above the high of the day. Remember, some of the reversals were fairly relentless, like this, leg up. But I still think, like this, just tiny pullback before more up. I still think with all three moving averages close to one another, it's telling us that the market's fairly balanced. So I still think it's more likely this will be an exhaustion gap and that we'll pull back down to the 60-minute moving average sometime soon. Bulls buying 15 low, willing to scale in lower, stop all the way down below 8. Bears hoping to break back below the 60-minute moving average, but I think the bears will need many bars before they can convince traders that they've taken control again. The reversal is strong enough to make me think that 70% chance we've seen the low of the day. $16 is a high one buy, but a bear bar. Bulls bought the 15 low, and I think a lot of them will scalp. Bulls trying to maintain the gap, 12 high for the measured move up. The single most important thing right now, besides the reversal, is all three moving averages close to one another, and that's why I think we're going to dip below the 12 high. Moving averages close to one another means balanced, neutral trading range, and if today's going to have some trading range trading, the bulls have to get disappointed, and one way to disappoint them would be to close this gap, which I think we'll do. Obviously, if we trade above 17 and just get 2 or 3 bull bars, I'll change my mind. But right now, I think we're probably going to go sideways here. Not a good looking buy, but I think a worse sell. So I think if you have to do something, 40 at the 17 high, I think you buy. But I still think sideways more likely. And if you do buy, you need a wider stop. Not necessarily all the way down to the 8 low, but probably below a 50% pullback. So, somewhere down here. Limit order bears need one more tick. Selling 14 high, betting on the trading range. What about stop order bears below 18? We have a double top. When a trend is strong, usually if you're selling, it's better only to sell with limit orders. And bulls can buy with stops or limit orders. What happens if we close the gap below 12? Well, it would increase the chances that we're going to go sideways for a while. Look what we did at this price level yesterday. Looks like we're going to close that gap and test the 13 buy climax low. However, I think 70% chance we've seen the low of the day. Now, this is bar 18. If we get to a new high, then 90% chance we've seen the low. If we get to a new low, 90% chance we'll not get all the way back up to the high. Right now, I think it's enough of a reversal, and the context is good enough, and the buy signal bar is good enough, so that 70% chance we've seen the low of the day. And that means that if we get a reversal, it'll probably form a higher low. You can see it looks like we're probably going to close the gap 12 high. Sometimes you get fairly deep reversals, deep pullbacks when you have a reversal day. Look how deep this one was, right? It had a series of very strong bear bars, yet still a higher low. A few bars down, pretty good bear bars. Big bear breakout, they bought it. It's still possible that we just get a brief reversal and then strong rally. But what's different here is the initial sell-off was small, so there was not much to reverse. And when you get a small initial sell-off, you have a better chance of a big bull trend afterwards and a new high. So is this a reversal day? I think of it more as an opening reversal, a brief sell-off and then a bull trend day. So I think of this not so much as a reversal day as just an opening reversal, a brief sell-off. There was no significant bear trend, so I don't think of it as, see right here, never had a bear trend. So I think of it as an opening reversal. This is a brief sell-off, so not really a reversal day. But you can see a lot of the days, no matter how strongly up they were, they spent a lot of time sideways and had some decent sell-offs along the way. And I think that is more typical. So I think that's probably what we're going to get, sideways. Buyers or sellers, 16 low. Well, you have bulls trying to prevent the market from dipping below the 12 high. They're trying to keep the gap open. They still want the measured move up. And therefore, buying above 19, if it's a bull bar, is a higher probability bet than buying above 17, even though 17 was profitable, because this would be a second test of the breakout point, the 12 high. Still always in long, possibly always in long for the rest of the day, but we still might get a deep, sharp pullback. Bulls will probably buy the pullback. So right now, bulls stop below 8, and they'll buy everything. They'll buy any reversal down attempt. If you buy above 19, to put a stop below 19, it's probably okay because the context is good. The bulls are trying to keep the gap open, and if they fail to keep the gap open, then it increases the chances that we'll get a deeper pullback. There are a couple things about this that I think make it less good. I prefer the breakout point 12 to have a pullback and then a reversal up, not be simply one bar. And then we're starting to get dojis. So not as strong a buy setup as it could be. 60-minute moving average probably will prevent the market from falling very far, but we could test down to yesterday's close and low, release the low of the trading range one more time. Now, can you sell on a stop below 19 for the failed high 2? I would not. I think we're probably going to stay always in long. For the bears, they have a double top. They want to break below and a measured move down. But to me, that's a buy. If we get down there testing the 9 buy signal bar high, testing the 13 low, testing the 60-minute moving average, it looks like we're starting to go sideways here. For what can the bears do to make traders view this rally as a lower high in a bear channel? They would need a pretty strong reversal down. Without that, bulls will buy every reversal down attempt. Exhaustion gap. Initial target, the buy climax low, and the 60-minute moving average were already there. It's still possible that this is a lower high in a bear channel. Do I still think 70% chance we've seen the low of the day? Well, every bar that we get down reduces that probability, but I still think, around a 70% chance we've seen the low of the day. Let me get rid of this measured move. Bears want the measured move down. Double top. That's the measured move using the lower of the 2 highs. If the market instead uses the higher, then it would be here. Let me just bring up a minor point here. Bulls buy 19 high, disappointed by one tick trap. A lot of the bulls try to get out break even. They place a limit order one tick above the 19 high. It hits their limit order on 21, does not get filled, and then a lot of them just sell at the market. So a lot of this is bulls giving up, expecting the gap to close and for the market to get down to the 13 low. And the bears are doing the opposite. They were able to trap the bulls with that one tick trap above 20, and they knew a lot of bulls would be disappointed and concerned that we would close the gap. And the bears placed limit orders to sell either at the 19 high or, one tick above, trying to trap the bulls. Obviously, very strongly down here. So it's no longer 70% chance, probably 60% chance we've seen the low of the day. Big enough surprise, probably at least a small second leg down. Now, what about buying the close of that and risking here, looking for the market to get back up above the top of the climax? I think it's probably early. That's a big enough surprise bar so that we're probably going to need at least a micro double bottom before bulls will buy. Can you sell on a stop below 8? I'm not going to. If it does get below 8, I might sell a pullback, a bounce. If it closes anywhere below the midpoint of that bar, we're probably always in short, but I am trapped out right now. I wanted to buy down here, but it's falling too quickly, so I have to wait. Testing yesterday's low again. So this is where they bought earlier several times. Up, up, up. But down too strongly for me to buy without it first going sideways a little. Bear trend, bull breakout. Bulls want higher low, major trend reversal, but down so strongly, a lot of the bulls will wait for at least a micro double bottom. Anyway, I made the point earlier that when you get these reversal day attempts, sometimes you get crazy sell-offs. So reversal day, and look at this sell-off. This is similar to today. Still more likely than not, it's going to form a higher low. But big enough down, I need either a strong reversal up or for the market to go sideways a little bit before I look to buy. And I'm trapped out of shorts right now. Location, good for the bulls. All right, testing yesterday's low again. But momentum, good for the bears. Ten-point rally. I'll use the double top bear flag example. Here we got a reversal up, 8.5 points, still got a bear trend. The bulls tried to get a reversal day. It failed, and we got a bear trend. This is a reversal attempt that failed. Another reversal attempt up that failed. Reversal up, failed. Reversal attempt up that failed. I still think the odds are that today's going to succeed. I still think the odds are today's not going to become a big bear trend day. I think right now it looks like it's going to be a trading range day. All three moving averages are relatively flat, and that means they are magnets, and they increase the chances that we're going to go mostly sideways. Remember, on the daily chart, yesterday was a doji day. I said probably today would be a trading range day. That the gap down yesterday was so big, it was unlikely that we were going to go straight up. The reversal up Tuesday was so strong, unlikely we're going to go very far down, and that means probably mostly sideways today. All right, so what about buying above 23 for the higher low? Like this. Now here we had some hesitation. Parabolic spike, pullback parabolic channel, so spike and channel. That gave an additional reason for the reversal up. Here we don't have that. You can argue a second leg trap in a trading range day, leg one, pullback leg two. But I'm going to wait. Bulls buying yesterday's low, again, made money. So right now I'm on the sidelines, thinking that more likely we're going to go up, but it's down too hard. I needed to go sideways more. If you're buying 23 for the higher low major trend reversal, it's a swing only. I prefer higher probability, so I'm going to wait a little bit. Not a good buy signal bar, and not a good follow-through bar for the bears. I need more information, so I gotta wait. Still most likely a trading range day. Big down, big up, big down, big up, big down, right? Trading range day with big reversals. Reversed up, reversed down. So this might be what the day looks like. It might be one of these days where you have just big abrupt reversals all day long. We reversed up, we had a second entry buy. We reversed down, we had a second entry sell. Here a micro double bottom. Here a double top. Just lots of crazy reversals, difficult to trade. Here, micro double bottom, an II for the sell up there, and then a second entry, third entry short, second or third entry buy, second or third entry buy, second entry short. So if we're lucky, we'll get this kind of a thing where you have second entry reversals. Trading range more likely than bear trend or bull trend. Well, I'm trapped out. The odds favor a trading range day, and I don't want to be selling at the low. Can you buy the 8 low? I would not. This is a big surprise and big bear bars, so I would wait. Still might get that leg one, leg two, leg one, and then leg two starting here or here. Bulls made money, 8 low, again consistent with a trading range day, but it's down so strongly that I think it's too early to buy and probably too late to sell. With all of the reversals, selling at the low, buying at the high, I think the risk is great and the probability is not high. "60-minute chart testing that low from last week. Almost down to leg 1, leg 2. Still solid close, but I'm going to wait. Too many reversals, and I don't want to be selling too low. And check leg 1, leg 2 on the day. So that's leg 1. We're right around leg 1, leg 2 on the day. Leg 1 pullback, leg 2. Solid close bearish 25. Probably disappointed 26. But the bulls probably will need a micro level bottom. It's possible 24 and 25 created the micro level bottom, but a lot of bulls will need more than just a single bull bar 26 before they buy. This is the dance that the market often does. Sell the close 25, bull bar 26, disappointed bears, and they have to decide what to do. And some will try to get out, break even around the 25 close. Some who sold the 25 close try to sell more 1 or 2 points higher and then get out, break even around the 25 close. Some will hold just in case it becomes a huge bear trend day. The behavior over the next 2 or 3 bars is important because it tells us whether we're going to get a base and a reversal up or a continue down. We're very close to that leg 1, leg 2 measured move. So leg 1 and then pull back, and then leg 2 started here or here. I still think it's more likely that this entire sell-off today is a bull flag after this reversal up on Monday, Tuesday. The bears, low 1 short, but sell climax, too much risk of a parabolic wedge. 1 pullback, 2 pullback, 3. So if you're selling below 26 or 27, you have to be pretty quick to make decisions. Unlikely to be to continue down very far from here. I talked about this as a minor reversal. I thought we would get a higher low. Instead, we're getting a lower low. This is so strongly down that this reversal up is probably minor as well, which means that it probably will have to pull back before the bulls can get a strong rally. It's similar to this kind of a day where the market just makes all kinds of crazy moves. Here we went to a new high and reversed down. Here we're going to a new low and we're trying to reverse up. Sell the closed bears, 25. Unhappy, 26. A lot placed limit orders to get out break even. 27 low, did not let them out, and a lot of them are panicking and buying back the shorts here, so they're giving up here. Still always in short, still minor reversal, but like this, if you start to get 2 or 3 decent bull bars, it becomes always in long again. "15-minute chart, a lower low, but a big expanding triangle, low and then higher, and now lower. Not a very strong buy signal bar, but the context is good. So down, up, more up, more down, 2 legs down. Day session, more of a bear channel, bull flag. Back to the 5-minute. Possible simply a 2-legged trap, but with this as tight a channel as it's in, I have to wait. Two-legged trap, leg 1, pull back leg 2, you can get an abrupt reversal, but the first reversal is usually minor, which means you'll get some kind of a test down, typically. Two-legged trap, 1, sideways 2, and then abrupt reversal up. 1, pull back 2, small 1, big 2, lots of two-legged traps, big trap here, big trap here. Target, always the top of the most recent sell climax, usually corresponds to the moving average. What about the scale and bears 25? Will they end up losing money? I think they'll be able to avoid a loss by selling below a bear bar and then getting out at the midpoint between their second entry and the 25 close. But this is becoming always in long. Bulls probably need one more bar. Very abrupt reversal. Sell climax, very abrupt reversal. But we got a deep pullback again. So I think if this is what we're doing now, we'll probably get some kind of a deep pullback that would allow the bears to scale in below a bear bar and get out without a loss. So they buy that close, they sell that close, they sell more below a bear bar, and then the market comes down to their average entry price and allows them to get out without a loss. Opposite is true here. Buy the closed bulls, buy more above a bull bar, it gets back above the midpoint between their two entries and they can avoid a loss. So nobody's making money with these scale in trades, but they're able to avoid a loss. For traders who did not sell the 25 close, most traders did not, they could sell below a bear bar, especially if we get a couple small legs up, or at least a scalp, looking for the market to retrace half the way down to that low close. $60-minute chart still looks like a bull flag, 2 legs down, 1 pullback 2 after a strong reversal up. So still more likely that we're going to try to go higher over the next few days. Very difficult day to trade. I'm not taking as many trades as I would like, but I haven't had any losers yet, so I'm okay. Interesting bar. Sell the closed bears who sold 25 close will scale in more. They want to be at least 1 or 2 points above the 25 close when they scale in, because they're looking for the market to come down to the 25 close. They want to scalp on their second entry, so they want that second entry to be at least as big as a minimum scalp. Big enough reversal up. A lot of bears will wait for a micro double top. Also, we have 2 magnets just above moving average and the 24-25 sell climax high. So probably going a little bit higher. Scale in bears want the bar to close near its low. They sell that close and then they sell more 1 tick below the bear bar, and this is their average price. Okay, that's not good enough, I think, for the bears to sell. So more likely buyers below 29. The bears want a reasonably good bear bar, decent sized bear body. %50 pullback, 1 tick below, so you got some bull scalpers buying there. In addition, some bulls simply buy the 28 low, betting that it's not a very good sell. You can see the bulls have bought the 50% pullback, got filled at 24.37 even, and it bounced 5 ticks, and they were able to scalp out. So you get some selling at 24.38 and a quarter. The bears, I still think the sell the closed bears 25 will be able to avoid a loss, but we may have to go sideways more or sideways to up more before they can get out. And for the bulls, it's more of a scalp. I still think we're always in short. The bulls needed to do a little bit more with either 28 or 29. Does it become always in long outside up? I think it needs more than that. It needs outside up, plus at least 1 pretty good bull bar. The bears want a double top 24 at the moving average and then a test back down toward the 25 close, but they need a good bear bar. A big bull bar is not a reason enough to buy, right? You're at the target, the top of the sell climax, at the moving average, and we still have the magnet of the 25 close. Similar to this, bulls want a measuring gap. They failed. Bulls trying to get a measuring gap again here. We did not quite reach the leg 1, leg 2 target down here. So, and the reversal up, although it's okay, it's not strong enough, I think, to convince traders that we're back to always in long. So at this minute, it's still more likely that we're going to test down 1 more time. But if we get a big bull bar 31, it'll flip it to long. The bears selling, they want a decent bear bar. So they want 31 to be maybe a 2 or 3 tick bear body closing on its low. Otherwise sideways. The bulls need a breakout, otherwise traders do not buy. The bears need a pretty good sell signal bar, otherwise traders do not sell. And if we do not get either, then we'll probably go sideways for a few bars. They're not going to let us know until the final second if it's a 2 or 3 tick bear body. Okay, only a 1 tick bear body. It's a low too short at the moving average, double top 24 high, but only a 1 tick bear body. So a lot of bears will not take that sell. They'll wait. Bulls want a gap. The bears want a wedge. Right now, still probably always in short, so slightly higher probability that we'll get a wedge, lower probability that we get the gap. Big sell climax, so that is a magnet up there. I think the bulls need one or two more bars to convince traders that it's back to long. Bulls are trying to do this. This is the kind of day that I think we have a lot of big reversals. You're never really certain if the low will be the final low. You're never really certain if the high will be the final high. You can see because 31 was not a good bear bar, traders did not sell it. 32, a better bear bar, but it did not go below 32. 5-tick trap for the 30 high bulls. So they will get out if it doesn't give them their extra tick. And a lot of the bears want a decent sell signal bar, so not likely on 33. The bears will probably need one more sideways bar with a bear body. Well, that's the wedge, the low 3 at the moving average, double top 24. But the bull body, a lot of traders will not take the sell. Just like the bulls got the failed breakout, they failed to get their breakout here. The bears may fail to get their reversal down from the wedge bear flag because of a developing tight range and a bull bar 33. Limit order market. Bulls had a potential breakout, the bears sold it. The bears have a potential wedge bear flag and the bulls might buy it. Trying to become always in long. If the bears get a bear close on 35, closing there is low, bears will sell it. And bulls trying to get a bull breakout above the bear flag. Final bar of the hour. And for bulls, a big high 2 buy, leg 1, pullback, leg 2. Similar to the daily chart, leg 1, pullback, leg 2. I still think the 60-minute chart is always in long, and therefore this reversal down probably minor, even though on the 5-minute chart it's pretty dramatic. What about those sell the close bulls, sell the close bears 25? I still think it's more likely than not that they'll be able to avoid a loss. So I still think we're always in short, but it would not take much to flip it. Final seconds, bulls trying to get a good 60-minute buy signal bar, bears trying to get a good 5-minute sell signal bar. Bulls have an okay buy signal bar. Bears do not have a very convincing sell signal for their wedge bear flag. Bulls keep trying and failing. Right, that's why I'm saying it's still always in short. Bulls trying to get a bull breakout above a bear flag, and the bears want the test back down near the 25 close. Bears not getting a strong sell signal bar. 29, 1-tick bear doji. 31, 1-tick bear doji. 33, a bull bar. And then 37, again, 1-tick bear doji. tight trading range, bad for stop entries, buying above 30, 32, 35, and bad for selling below 31, 33. But breakout mode, so one of these breakouts will succeed. We went above the 60-minute high, triggering the buy signal, and we got a one-tick breakout and a reversal down. Bulls trying to create a 5-tick trap, but as I said, I think it's still always in short, so I think the bears will make money. I don't know how far down we go. Not obvious, subtle support at the midpoint of the two entry prices for the bears. So this is a target one tick below that line. The bulls hope for another failed bear reversal, but I think the math is better for the bears. Suppose we reverse up here. I think the bears might give up. This was their chance. It's not a particularly strong sell signal bar, but at some point they give up. They keep trying to get down to their average entry price, and if it does not get there, they simply buy back their shorts and quit, and then you get the bull breakout. Bears might give up here, right? They have a 5-tick trap, a wedge bear flag. They've had several attempts down, and I think, at some point they give up. I don't know if this is good enough to get them to give up. The problem everybody has right here is the tight range. It's a bad environment for stops, but the bears, I don't know how much longer they'll continue to try to get out. They sell this close, they sell more below a bear bar, and it keeps trying to go down, and the bulls keep buying it. So at some point the bears say, I got to sell higher. This is not high enough for me to sell. The bear scalpers bought back I sold below 37 and I bought back break even. And the ones who did not buy back, they have to buy back above 38. The scalpers and swing traders, I think the bears might be giving up here. They sold the close and they keep getting attempts. They can't get good sell signal bars. So this increases the chances of a successful breakout above the bear flag. Tight trading range, so you can't be too confident, but the potential here is good for the bulls. So far, not good for the bulls. So far, a continuation of the range, but the potential is good. So if they do not get they did not get a big bull bar, they can then try to get a series of bull bars. Bears want 38, 39 to be a pullback from the breakout below 37, and bulls want this to be a failed bear breakout and a reversal up. Tight trading range, so probabilities not all that high for the bulls or for the bears for stop entries. For limit orders, traders are making money buying below everything, selling above everything. I would not sell above 38. Bulls trying hard, right? They're trying to prevent any kind of a pullback until after they get their breakout. 3 consecutive bull bars. Maybe always in long, maybe one more bull bar. The bulls would like to get the breakout above 37. Let's say the bears get a double top here. That would be good for the bears, but with all the tight trading range and the bull reversal, a lot of bears will not take the sell. The bears had good opportunities here and could not get good sell signal bars. I keep saying the bulls need a little bit more, and I thought they were going to get it above 38 or with a series of bull bars here, but so far they're not getting it, so the bears still have a slight probability advantage. the bulls have a reversal here, but not compelling enough to make me think it flipped it too long. So, I look back to the last time it was clear, and it was clear here. So it's still always in short. It would only take one good bull bar to flip it. What about buying on a stop above the double top? Well, I don't know, it's probably okay, but with all the reversals, you got to be pretty quick, because in general, if you're buying where there's an obvious stop, the bears will stop themselves out there. 50-50 chance the bears will get a second entry short, a failed bull breakout. 50-50 chance the bulls will get a successful bull breakout. I guess I think the probability is slightly higher than 50-50 for the bulls, because the sell to close bears 25 are going to get out at some point if they have not already gotten out. And when they get out, they could buy pretty quickly, and they could create a measured move up, taking us up to the 21 sell climax high. Because of the tight trading range, I had a buy stop to buy above 41, and I just canceled it because of the tight trading range. I'm looking at it, and I'm thinking I'll just wait to see what the breakout looks like. Issue is probability, right? When you're in a tight trading range, even if you get decent buy and sell setups, the probability is never as high as you want. Sometimes you hear people talk about tension building. We're getting higher lows and relatively flat top, so a wedge, you can call it a triangle. Traders are expecting a breakout and some kind of a measured move. If we do get the breakout, chances are, let's say we get the bull breakout, chances are it'll disappoint the bulls and not go up as far as they want. And for the bear breakout, I think probably buyers below. We've had 2 legs down, possible second leg trap, and we've had a big rally up from the 25 close. The sell to close bears who are still short and who sold more below 43 probably will be happy to avoid a loss. So if we do sell up here, they'll probably buy back their shorts at their average price. And right now, this is their average price. They sell there. This is the first bear bar that has more than a 2-tick body, and then the market traded below it. So this would be, these bars only have 1-tick bear bodies. This has a bull body. So this is probably, if you're a scaling bear, this is where you sell. And you'll probably be very happy to be able to buy back your shorts right here if we get there. And if we do break above that 41 high, I think a lot of the bears will finally give up. I thought they were going to give up after 38. And they still might. This might be still a pullback from this reversal. But we still do not yet have a strong sign that the traders are giving up. This is a sign that the bears are giving up. This is a sign that the bulls are giving up. The bulls need a strong bear bar to be confident that the bears are giving up. If they get it, we'll probably go up for some kind of a measured move. Bulls got their breakout, big enough breakout, probably a little bit more up. The one hesitation I say about that is the possibility of a second leg trap in a trading range day, leg 1, pullback, leg 2. I don't know if you bought it. I bought it with a limit order on the pullback. I bought it as 45 was forming. Clearly always in long with the breakout. Bulls trying to break strongly above the 60-minute moving average, and their next target is the sell climax high and possibly the high of the day. You know, I said earlier that the bulls tried to go outside up here. They went outside down, above yesterday's high, below yesterday's low. They tried to get back above yesterday's high and then failed. This is that 60-minute buy triggering, not a good looking buy signal bar, but good context, 2 legs down, 1 pullback, 2, and not a good buy signal bar. So far, good entry bar, but there's still 13 minutes before the bar closes. Good looking pair of bull bars, always in long. Still a possibility of a 2-legged trap, but the bears probably will need at least a micro double top. You know, like here, the bears got a small double top. The bulls are hoping that this is a resumption of Tuesday's bull trend. So bull trend, 2-legged pullback, and trying to resume up. But the bars are not especially big, and the bears are still in a bear channel. But we've probably seen the low of the day. Obvious targets, this lower high and the trend line. Even if you get a 2-leg trap, usually the bears get at least a micro double top. The bears are hoping the bear channel continues, lower highs. When you have a broad bear channel like this, the market often goes always in long, as it did here and then here, yet continues to form lower highs and channel down. You know, more likely we're going to get at least a small second leg up, and we'll test the trend line and test the 18 high. And right now, I think it's probably more likely than not that we'll get back up to yesterday's high before the end of the day. Probably buyers at the 47 low, buyers 1 point from the 46 close, buyers at the 60-minute moving average. So right now, probably the gap will stay open, and therefore a lot of the bulls will put stops a couple ticks or a tick or two, probably 2 ticks below the gap, the 37 high. Technically, they could keep their stop down here, but it should not pull back. At least it should not pull back more than a tick below the breakout point if the bulls are going to get a second leg up. And for the bears, I'm not willing to take the short. If 47 was a better looking bear bar, I might take the short, but it's not strong enough for me to take that short. Second leg trap here, a bigger bear bar closing on its low, bigger bear bar closing on its low. Here, the bears needed a second entry. They need to make this a 2-legged trap. Well, you know, they either need a big reversal down or 3 or more consecutive bear bars. Even with that, unless we get a big reversal down, I still think the odds are we'll get at least a little bit more up. We have room to the top of the sell climax, the trend line, and the lower high. Two bear bars, neither one especially strong. A day with a lot of reversals, so you have to assume that bulls and bears will get disappointed repeatedly today. Will this make it always in short? I think the bears need more. They need to get below 44. Obviously, if they get a bar that looks like this, you know, then it'll be always in short. It's just one of those days where you just get lots and lots of big reversals, and to try to argue from a fundamental point of view is useless. You know, in the market is having strong legs up and down, repeatedly reversing. There's nothing fundamental going on. It's purely technical. market testing support and resistance, a lot of trading range price action. We had that huge reversal up the other day, and then the big gap down in the doji bar, warning us that bad follow through, more bad follow through, probably sideways. The legs are bigger than what you typically see in a trading range, but that's all that's going on, is simply a trading range. Can you short 49 close? I would not. Here, maybe, yes, sell the close, but this is a big enough breakout. The odds still favor buyers below, but sometimes it just keeps going down and down and down. We had that last week in that huge bear day over here. Okay. Second leg up, looks pretty good. Possible second leg trap, a low 2. And then 3 bear bars. Is it short yet? No, not necessarily. Probably still always in long. Bigger bear bar closing on its low. Maybe it's becoming always in short. 5 bear bars, probably sellers above. I don't know, still might be always in long, but sellers above. 6 bear bars, there are sellers above. 7 bars without a bull body. The bulls are trying to get a higher low. And then we got that, a bear bar closing on its low below the bottom of the bull leg. And then bulls trying to reverse. And then bear breakout and follow through. Probably some kind of a measured move down from a failed double bottom. Tails on all 3 bars, but a lot of the bulls will wait for some kind of a micro double bottom before buying again. And the bears, they need more. With those bars closing above their lows, it's not as bearish. It's not bearish enough to make a lot of bears sell this far down. Testing the breakout point, right? That is support. The bulls would like to keep the gap open. They'd rather, if the market dips below 41, they only want it to dip by 1 tick. You have scale and bears who sold that high, and they sold more higher, for example, below a bear bar, and they're able to get out, break even right now. So they buy 1 tick above the high, they sell more 1 tick below the bear bar, and this is their average entry price. So the limit order bears were able to get out without a loss. But some bears will try to have this bull reversal fail and continue all the way down. More likely, we're going to get a second leg up. We might have to go sideways a little bit first because of the 3 bear bars. We're at all 3 moving averages. The limit order bears are trying to get below 41 to scalp out, and the bulls are trying to trap the bears. But the 3 bear bars each getting bigger bodies. I think the picture is confused, always in long, but probably sideways here around all 3 moving averages. It's a high 1 buy, but with the 3 bear bars, some bulls might wait for a second entry buy. Bears got their 1 tick pullback below the breakout point, and they bought back their shorts. And bulls probably buying around there as well. Because of the number of bars down, the market might have to go sideways for a few bars before the bulls can test back up. It's a reasonable buy the close bar 46, so bulls probably will look to scale in. Let's say they bought the 46 close or the 47 low, they'll look to scale in above a bull bar. They might wait for it to go sideways a little bit more first. The bears are still hoping for a two-leg trap and a move down to the bottom of the buy climax. Pretty good move by the bears, but I still think it's slightly more likely that we're going to test up. There's a breakout pullback short, but at support, 2 moving averages and the breakout point. A lot of bulls are hesitant to buy unless we get at least a micro level bottom. And for the bears, I think a lot of them bought back their shorts, and that's part of the reason why we bounced here. Suppose we get a bull IOI 54. It's still not a very good looking buy setup after all these bear bars. It's a second entry buy and a higher low, but I don't know. I'm not enthusiastic about it. We should get back to the 46 close. Bulls giving up. Might get a second leg trap down, just like we got a second leg trap up here. I am flat, and I'm hesitant to sell too low because of the possibility of the second leg trap. Breakout below the bottom of the buy climax, about a 50% pullback in the rally. Are we always in short? I don't know. I think the bears need more. Possible second leg trap. 1 pullback 2, second leg trap. 1 pullback 2, second leg trap. 1 pullback 2, possible second leg trap again. I'm trapped out. Trading range day. Traders have been buying strong sell-offs and selling strong rallies. This is a strong sell-off into an area where the market went sideways for an hour and where it reversed up twice, about 3 or 4 times. So for me, not a good location to sell, but I'd like to wait for a second entry buy, which means I'll probably wait a few bars to see if the bulls get a second entry buy. Bulls trying to do the opposite of the bears up here. They're trying to repeat this. Second leg trap, 1 pullback 2, 1 pullback 2. Second leg trap. They never look good enough, buying above 26, selling below 45. But the math is pretty good. I usually wait for a second entry buy or a second entry sell, or I wait for a strong reversal. Limit order bulls might have bought 46 close or 47 low or the 54 low, but the channel is too tight for me to take the first reversal up. Sometimes on days like this where you get the abrupt reversals, I either miss the swing because I'm wanting a second entry trade, or if I take it, I end up scalping, so I don't make nearly as much as swing traders do on these legs. Bears trying to get a gap and a measured move down. Now we're almost to the measured move down. So I would not sell here, but I'd like a better looking buy setup. Bears hesitant to sell. The market has reversed up here so many times today. And we've had several second leg traps. So traders are hesitant to sell too low after a second leg down. Bulls want a second entry buy. Bears want the second entry buy to fail and create a low 2 short, low 1 and then low 2. On trading range days, the probability is never as high as anyone wants, and The risk is always greater because you have to use wide stops. Not a great looking buy, but too low to sell in a trading range day. Limit order bulls 59 probably will make money. Stop order bulls 61, I don't know. Target always the top of the most recent sell climax. Second entry buy, but I think too far up, so I would wait. And for the bears, a little too short, 2 legs up, 59.61, but I don't want to be selling below a bull bar in a trading range day at the bottom of the day. Bears getting a low too short, but fairly low in a trading range day at a price level where the market has reversed up many times, so not a very good looking sell. Also, the limit order bulls 55 were able to make money, and that should make bears even more reluctant to sell too low. I think difficult to do anything right here. Low two, okay swing, but bottom of a trading range. Bear channel, bull flag. The odds still are that we're going higher. It might not get there today, but this whole sell-off for 2 days, I think, is a bull flag, more likely than a bear trend. Although I did not read the news, something happened to retail today. This is Walmart, around 10:30, began 10:50. Costco, 10:50, 4% down. TJ Maxx, Target, 4% down. Bulls trying to get at least a minor higher low. Location, good for the bulls. Overall day, good for the bulls. Trading range day, second reversal up. If 65 closes on its high, probably an okay buy, but it probably will turn into a scalp. Outside up, so not a great looking buy, but we're in the buy zone. I think a lot of the bears will get out above 65, and a lot of bulls, I don't know that they want to buy with stops this high up. For the bears, they have a low two bear flag, 62, a bear breakout, and this is a pullback, but too low in a trading range, and probably buyers below 66, especially if it has a bull body. For the bulls, they have a double bottom, reversal up 65, and they've used 66, 67 as a pullback. And everyone is going to be looking at the appearance of 66. If it's a 3 or a 4 tick bear body, the bears have a better chance. If it's a 1 tick bear body or a bull body, probably buyers below. Probably back to always in long. Maybe it went short on the 3 bear bars 49. Maybe it went short on the breakout on 56. But probably back to long here. Probably buyers below 66. For the bears, a double top 62. But fairly low in the range. And the bulls have been able to hold the market, preventing sell-offs at this area all day. The bear case is that, yes, the bulls have stopped sell-offs, but the bulls have been unable to get a sustained rally. They have a 2-bar rally here, and it failed. I still think it's slightly better for the bulls than the bears here. What about the limit order bulls who bought the 46 close? Well, theoretically, they bought more above 58, and this is their average entry price. So you probably have bulls selling here, trying to avoid a loss. They buy here, they buy more here. This is their average price. So that is a resistance level. It's still possible that we could get back up to the 46 close and they could avoid the loss. But right now, we're running out of time and I'm not sure that we'll get there. And for the bears, they want a break below the range. And the market has reversed up repeatedly at this price level. So I'm not willing to short down here. You know, there's always a possibility of a sell the close or even a buy the close finish. But I want to see a strong breakout before I'm willing to sell closes or buy closes. Probably buyers here, 66 low. Bulls want a double bottom pullback, so double bottom breakout pullback. So a higher low or a triangle. 3 pushes down, 1, 2, 3. And the bears want the double top to reverse below the 65 neckline and fall for a measured move. I think more likely we'll get the higher low. Bulls trying to hold the low. They have a small double bottom, higher low. So small bear trend and double bottom, higher low. Not a particularly good buy signal bar. And for the bears, not a good sell signal bar, 66. I still think we're always in long as long as we're staying above the 65 or 57 low. And I think it's difficult to do anything right here. That's the buy, but not all that persuasive. 5 ticks. The bulls need one more tick, and then they want to get a breakout above the neckline of the double bottom neckline. Takes us all the way back to the 46 close. Do we get there? You know, I don't know. That's not what I want to do. We have a channel, if you want, you can call it a triangle, and bulls trying to get the breakout. I thought the 46 close was a reasonable buy. And usually if you take a reasonable buy and you buy more above a good bull bar, 59, you're able to avoid a loss. The average entry price from the bulls above the 46 close and 1 tick above the 48 high is right here, right around the 60-minute moving average. So I'll probably go at least 1 tick above that red line. We have a double bottom. Bears trying to get a double top. But I think the odds favor the bulls. We have a double bottom, higher low. We're at a support area, and we have a magnet above. For the bears, a bear trend and a double top pullback. We have a reversal down, double top, lower high. But I think a trading range day, we've had multiple reversals, and in general, if the market's low, it's better to buy. And if the market's high, it's better to sell. We're low, so we're in the buy zone. And therefore, it's higher probability to be long here than to sell below 71 for the double top, lower high. It's a triangle if you want. You got higher low, double bottom, lower high, double top. Bears want head and shoulders top, bear flag, left shoulder, head, right shoulder. And bulls want a double bottom, higher low, and a magnet above. You can also argue that the sell the close bears 25 never got out. They never had a chance to get out. But they had a little bit of a chance. 29 low, got to within a tick. 30 low, the bears tried to get out. So the bears have, you know, they've had some opportunity to avoid a big loss, whereas the 46 bulls have not had any opportunity to get out. So I think it's more likely that we get up there. The bears break out above the double top. I still think always in long, but obviously not very good. It looks like the bears sold the 69 high and scaled in higher, betting that it was a weak buy after the 2 bear bars in the doji bar. Bulls trying to get higher lows and higher highs. Still probably always in long. Are we going to get a buy the close to sell the close finish? Probably not, right? But I still think the Bulls have a decent chance of reaching their exit point. Lots of reversals in the trading range. Looks like probably a trading range finish. I have to say I'm still slightly more bullish than bearish, but we're running out of time. Now an expanding triangle. I'm flat. I did buy above 69. I scalped out part and I got out the rest around break even. That was my last trade. I did not sell 72, did not buy 74. I probably will not buy 77. We have an expanding triangle and a failed head and shoulders top, left shoulder, head, right shoulder, but too many reversals in too little time. If 77 closes on its high, it's probably an okay buy, but I'm not sure that the math is good enough to take the trade. Bulls trying to create a good enough bull bar for at least a scalp back up to the 74 high. But if it's not perfect, I wouldn't take it. And even if it is perfect, you're risking a lot to make 1 or 2 points. I'm just looking to see if I'm missing anything. Might get one more push down, so it might be 1 pullback, 2 pullback, 3 tomorrow. But I still think this is a bull flag rather than a bear reversal. Remember also, we're getting into that seasonal window when there's a upward tendency end of August into September 5th. Overall, September is generally the worst month of the year. But that's really deceptive. If you look at the average gain or loss over the past 50 years, 100 years for any month, the best month might be up 1.5%. The worst month might be down 1.5%. So to say September is the worst month means it's just a little bit worse than average. The stock market obviously has gone up for the past 1,000 years, and therefore the average month goes up. So the average gain per year is 8%. That means the average month goes up a little bit more than 0.5%. September on average falls a little bit more than 1%. So it's a little bit more than 1% worse than an average month. 1% when the S&P is at 2,000 is 20 points. So that means on average, the S&P is up 22 points less, or 20 points less than an average month. And that's over the course of 20 days. So, that alone is not enough reason to sell. Oh, it's September, I got to sell. September's a down month. No, September, on average, gains 20 points less than an average month. On average, maybe it loses 20 points, but that's over the course of the month. That's one bad day. Bar 78. It looks like nothing. It's only 5 ticks tall in a doji bar, but it had 75,000 contracts. Typically the biggest volume bar of the day. Pretty exhausting day. Lots of incredible reversals. We had that extreme buy climax day on Tuesday, and then yesterday we had that big gap down, and you look at that and you say, oh, that's not right, that shouldn't happen. And whenever something shouldn't happen but does happen, it's important. And it's basically a gap spike, and the bears are trying to get a correction down from there, and it's always unclear where the correction ends. Was it here, a double bottom higher low? Was it here, 2 legs down, 1 pullback, 2? Is it here, 2 legs down, 1 pullback, and then 2? Is it here? It's not at all clear. You know, this might be the end of it. We have two big legs down, one, and then sideways, and then two or two. Final minutes of the day, the 46 by the closed bulls might end up avoiding their loss. We have an expanding triangle here. The bears head and shoulders top, but bad breakout, right? You get the 77 reversal bar. I did buy the 77 high, stop below 77, but I scalped out with 1 point. I'm back to flat. Today, because yesterday was an inside day, not only an inside day, but in the middle of Tuesday's range, right? And we opened above today's range, yesterday's range, and yesterday was a small day. I thought we had at least a 50-50 chance of an outside day. So we opened above yesterday's high. I thought 50% chance we'd get down below yesterday's low. 50% chance we would sell off and reverse up from above yesterday's low and get back to Tuesday's close. Well, we sold off in the open and had a decent reversal up. We have a second entry buy above 9, and it led to a 4-point rally. And then we had that reversal at 18, a second entry sell and a lower high. I thought the odds were we were going to get a higher low. And then we got 21, and you look at that and say, that shouldn't happen. That's just too big of a bear bar. And we ended up getting a new low of the day. Usually when you get these days with the strong reversals and then the bears try to resume down, you get a higher low. So this is somewhat unusual to get the lower low. And we're in a broad bear channel all day. Lower highs, lower lows. You know, I mentioned earlier that if you're in a broad bear channel, it's very common for the legs up to make the market always in long. Yet you still get a lower high and then a lower low. So always in long, and here we did not get the lower low, but we still got a decent sell-off. First bar, let me stop entries. We got the reversal down from yesterday's high with 2 closing on its low and 1 not being a bull bar, and therefore it's okay to sell. Looking for a test down, but I thought we might get an opening reversal up from either the 5-minute moving average or the 60-minute moving average. And then 3 closed on its low or near its low. Odds were at least a little bit lower. Big tail on 5, it's sell the close, but big tail usually means you're only going to fall for another 1, 2, or 3 bars before you either get a pullback or a reversal. Above 7, it's a failed breakout below yesterday's low, outside down, but it's a 5-bar bear micro channel, and therefore probably sellers above. But it's also an outside down day, and we did not fall much below yesterday's low after going 5 ticks above its high, and therefore there'll be buyers around 5 ticks below its low, and probably buyers below 7, a bull bar. And then 9, a good second entry buy, failed breakout yesterday's low. I thought the day was going to be a reversal day, and it was until bar 18. So probably going higher. Is it always in long above 9? You know, some traders would say yes. Some would wait until 3 bull bars, bar 11. And then we got a high one buy, 17, but 2 dojis in a bear bar, testing the sell signal bar low and the sell entry bar high. The scale and bears are happy to get back up there, so the bears will buy back their shorts, and the bulls who bought will be taking profits. And second, if it's right now at this point right here, it's probably a reversal day. But I said that very often in reversal days you get deep pullbacks, and therefore if you're buying up here, your stop is down here. If it falls below, you buy on the reversal up. So some bulls get stopped out below 8, and they bought again above 26 or 27, and then rode it up. Anyway, so stop entries. Below 2 made sense. Above 9 made sense. Below 18, I thought it was going to be a minor reversal, but I thought we might test down to the 9 high. I thought we might get a deep pullback in a trading range day. I thought the odds of a new low were small. Yet, you know, the odds are never 0, and the bears got their new low. Traders selling below 18. It's a low probability bet, and this time they won. buying the reversal up above 26. I would buy above a better looking bull bar like 27 closing on its high, or wait for a second entry buy. 30, not ideal. 38, I thought the bears were giving up. They could not get it back down to the 25 close, and I thought we were going to get a give up bar above 38. Instead, we got it on 45. Good reversal up 45, 46. I mentioned the possibility that 47 was a second leg trap. My concern was it only had a one tick bear body, and I ended up not selling the 47 low because of the one tick bear body. If it had a 2 or 3 or 4 tick bear body and closed near its low, I usually try to sell that, not necessarily expecting a bear trend, but expecting a test down to the bottom of the buy climax, 45 low. Then the 3 bear bars, 47, tails, body's not all that big, probably going down at least a little bit lower, but not a lot lower. Then we had a low 2 with 53, failing to get above the 60-minute moving average. Looks like we're probably going to test the 45 low. I thought we were going to stay above the low of the day, which we did, but I did not think we would continue down for another 20 bars, which we did. Failed bear breakout, 58. Can you buy above 58? I thought 56, 57 was a big enough surprise we'd get a second leg down, so I would rather take a second entry buy. Is 65 a second entry buy? It is, and it's probably okay. And you put your stop below 67, and you can see 69 came all the way, you put your stop below 65, and you can see 69 came all the way down, missed the stop, reversed up. Because of that double bottom, and because 65 was a reasonable buy, I thought, even with the 2 bear bars and the doji, I thought 69 had a decent chance to lead to a reversal back up near the 46 close, or the midpoint between the 46 close and a buy above 59, so somewhere up here. It did not get there. It got to within a couple ticks. And then 72 for the bears, an expanding triangle, 3 pushes up, 1, 2, 3, even though this is below that. You can call it simply a low 2. All right. I thought there would be buyers below. I did not think we would go to a new low, but I certainly am not going to buy below 72. Look what happened below 16. Look what happened below 47. I'm not going to be buying below 72. I was hoping for a higher low. We got one, 74, and can you justify it as a reasonable buy? You can. I did not buy it because 73 was too big. It made me concerned that something was not right. And then stop entry buy above 77, failed breakout below the bottom of the range, double bottom 30, higher low, major trend reversal, bear trend starting up here, and decent rally here, and this was a decent attempt at a buy, but a tight bear channel, probably a minor reversal, and then the buy above 65, the buy above 69 did not look all that good. This looked better, especially since it's a second entry buy 74. And then 4, buy the close, sell the close. I thought 3 was sell the close, and then 4, 5, 6 all sell the close. Disappointment 7, so the bears have sold 6, tried to sell more, 1 or 2 points higher, and you can see they bought back the shorts, tail on 8, bull bar 9, probably buy the close on 11 or 12, and you get out with the disappointment on below 14 or second entry below 18. And 21 I thought was a really interesting bar. I was not expecting that. And then if something that dramatic happens and the probability of it is low, you have to assume you're going lower. So is 21 sell the close? I don't know. 22. None of the bars were all that convincing. When we broke below 8, what do you do had you sold the 25 close? I personally would not sell the 25 close. Tails 22, 23, 24, possible second leg trap. We have a lot of trading range trading, so I would not sell down there. Is it buy the close 28? I think it's a minor reversal because the channel is so tight, but we may be channeling up, which we did. And so I don't think it's so much of it as a buy the close, but I do think of it as a limit order buy. And then 45, it's like 21. It's a surprise bar. It's a bull breakout above a bear flag. We should go at least a little higher. 46, we have follow through, And the limit order bulls who bought below all of these bars and bought more above here or here are able to get out break even at their first entry and a profit on their second. We have a second leg trap down. We have a lot of trading range price action. We're in a trading range and a broad bear channel. Both have second leg traps, and therefore 47 can be a second leg trap. The traders who bought the 46 close, a lot of them got out below 47. A lot of others got out on the third bear bar, 49, or on the bear breakout, 50. When does it sell the close? It's probably okay to sell the 49 close. My concern was the bear bodies were not that big and we had tails below. And then what about selling 56? Another surprise breakout like 45, like 21, and like 3, probably going a little bit lower, but not a heck of a lot. And then really not, it's a limit order market here, not buy or sell the close. Limit orders up here. The first limit order trade was selling the 7 high for a scalp and buying the 7 low for a scalp. And then up here, buying the 14 low made sense. And then here, what about buying? Actually, I didn't talk about buying the 19 high. It's a high 2 buy at the moving average after a reversal up. And I did not buy it because we had a second entry short 18 in what could be a trading range day. And I did not want to be buying too high. And then what about buying below bars, below 19? I would wait. I said we might get a very deep pullback if it's going to be a trading range day. And I did not want to buy too high. And then here, probably buyers below 28, 29, and 31. You have a low 2 short, but a fairly tight bull channel, and only a 1-tick bear body, probably buyers below. And then the bears kept trying to get shorts, a low 2 here, a wedge here, and then a double top here. But we're in a tight channel and then a tight trading range. The probability was just not good for stop entry traders. Buying above 30, buying above 38, or selling below any of those bear bars. We're in breakout mode. And then limit orders up here, buying the 47 low, scaling in lower. If you buy it, I think you have to get out on the third bear bar, 47, or above the little pullback bar, 52. And then what about buying near the 45 low, the bottom of the buy climax? Probably buyers there. We're probably going to remain a trading range day. And then through here, a limit order market. But the little legs up and down were big enough for 1-point scalps. Buying above 58 did not go up high enough for a scalp to get a 5-tick trap here. Selling the low 2 below 62 did go far enough down for a scalp. Buying above 64, I would not. Buying above 69, probably okay because of the double bottom higher low. Selling below 72 might be okay. Buying above 74, I did not buy it because it was a fairly big bar and it followed a pretty good bear bar, and the bears should not have had that big a reversal after this reversal up. So something is wrong. And then probably buyers below 78. It's still on the buy above 77. I still think the odds are this is a bull flag. I still think it's going to be leg 1, pull back leg 2, and we'll get up closer to here over the next several days. However, I say that, but I also think that whatever rally we get is a bull leg and a bear channel on the daily chart. I think we'll stay, we will fail to get above that major lower high. We might get up there and get a double top, but I think we're in the process of correcting down 150 points or so down to the May low here or March low here. Less likely this is going to resume up, even though for the past 8 years, every time we get a big high 2 buy like that, we went up to a new high. The weekly chart is just so extremely overdone that the odds are 3 bars down is not going to be enough to relieve the overbought condition. You know, we'll probably need 10 bars sideways to down, and 10 bars is about 2 or 3 months. Question, at what point does a a too low move on a trading range day become less likely than a two-legged trap and more likely a breakout with follow through. So I guess he's asking about this or this. A 2L, I'm assuming that means I don't know if that's a two-legged move in a trading range become less likely and a second leg trap more likely, a breakout with follow through. I think he's probably asking about this. I can't tell. Okay, for example, bar 26 for the bears and 58 for the bears, or 47 was a bull bar. Would you still think they were two-legged traps? I think, in hindsight, they were two-legged traps. This is a two-legged trap, a big one, leg one, pullback, leg two. Then we have a wedge bear flag for the first leg here, and then a second leg here. The second leg is usually a breakout, and when you look at the breakout, you think, oh, it's good enough to become a measuring gap. You got another leg up. But if you look to the left and you see a trading range or a lot of reversals, you got to be thinking, this might be a two-legged trap in a trading range day. And the same with this. You can say that's a pretty big bear breakout, but you look to the left, you see we're in a broad bear channel, a broad bull channel, or a trading range. Whenever you see a breakout to a new low or a strong reversal up, you have to be thinking that a two-legged trap is at least as likely as a successful breakout. The bears got a breakout here, the bulls got a breakout here, the bears got a breakout here, but it's mostly a trading range day or a bear channel. And whenever you see a second leg breaking out strongly, second leg down, so one pullback two, one pullback two, one pullback two. Whenever you see those strong second legs, and you look to the left and you say, oh, this could be a leg in a trading range day, you got to be thinking the two-legged trap. And when that's the case, for example, strong second leg down, I don't want to be selling above a bull bar. Strong second leg up, I don't want to be buying below a bear bar. That's my general rule. And sometimes you're going to be wrong, and sometimes it keeps going higher. And if it keeps going higher, then I'll look to buy as it goes higher. But when there's a possible second leg trap, followed by a second leg trap, bull trap, followed by a bear bar, I don't want to buy. When there's a second leg down, and it might be a second leg trap, bear trap, I don't want to be selling above a bull bar. So it's important, the follow through bar, what do you get? If it's a bear breakout and you got a bull bar, or a bull breakout and you got a bear bar, you got to be really careful. It increases the chances of a reversal. What do you think about a beginner taking breakout trades like sell the close 3 or 21 and trading using an always-in approach? I think it's okay. I think beginners should either trade with stops. The easiest thing is like a high 2 in a strong bull trend or a low 2 in a strong bear trend, or market orders during breakouts. But the market orders during breakouts, you might have to take a Xanax to take the trade because the market's moving fast. You don't have a lot of time to make a decision. And what invariably happens with beginners is by the time they say, oh, it's sell to close, I'm not going to get trapped out of the next one. It's sell to close, sell to close. I'm going to wait until I'm really sure. Okay, now I'm sure I'm going to sell the close. Okay, it's going up, not all that strong. Oh, now it's really strong. I'm going to buy the close. And then they see the bear bar and they say, oh, that shouldn't have happened. And they don't get out, and then they ride the whole all the way down. But I think the single best trade for beginners is a stop entry, especially a reversal, especially if it's a second entry reversal and the overall context looks good. And then a bull flag and a strong bull trend, or a bear flag and a strong bear trend. And then buy the close, sell the close. But you have to do it early. And if you're getting a breakout, you got to be really careful selling closes at new lows or buying closes at new highs. Also, if it's the 5th or 6th bar in a sell the close or buy the close, it's probably better not to take it. So 1, 2, 3, 4, you got to start thinking it might be near the end. 5, I definitely would not take that. 1, 2, 3, 4. I don't know, new low. I personally wouldn't take it. So, you got to do it early. When you buy the VXX, do you typically hold it overnight? Yes. If so, what is your usual holding period, and how do you counter the time decay? There's not much time decay in VXX. In all ETFs, there's time decay. And it's not like option time decay, but what happens is, and I may have this messed up, if you buy a mutual fund, you pay fees, right? The company that runs the mutual fund has to make money, and they take fees out. Well, guess what? The ETFs are all created by private companies, and they're managed by private companies, and they have to make money. And part of the way they make money is they're constantly taking a little bit of money out of the price of the ETF. And I don't know what the percentage is. It's small, but the result is if the S&P goes flatline and stays perfectly flat at 2,400 for the next 100 years, right, the VXX is going to go down because of the fees in the VXX. So you think the VXX will stay flat because it mirrors the upside down version of the E-mini. And the XIV, same thing. That mirrors the E-mini. And if the E-mini is perfectly flat, exactly at 2,400 for the next 10 years, the XIV is going to go down because every day the firm that runs it is taking some money out. But the fees are small. A lot of traders like VXX and XIV for day trading because the volume is so fantastic. Is VXX, even with the reverse split, okay, 500,000, 300,000 contracts or shares per bar, tremendous volume. You can enter and exit at the market with, virtually no slippage. So it's, they're really great day trading vehicles. Also, the patterns are reasonably clear. In a way, they're, often easier to read than E-mini because they have more data points. For example, the E-mini today, let's look at the VIX. Okay, the VIX today went, several dollars up. So that's 300 data points, 300 ticks range. And the E-mini was in what, a 10-point range today? So, and then 4 ticks per point, so it's about a 40 or 50 tick range. E-mini has 50 ticks of data, and the VIX has 300 ticks of data. It's like a camera. How many megapixels is your camera? Right? If you have more megapixels, the picture is clearer. And if you're trading an ETF with a lot of data points, a lot of ticks from top to bottom, a lot of times the patterns are clearer. Okay, what's your usual holding period if you hold VXX overnight? I don't know, sometimes I've held it, for a couple of weeks, but usually when sometimes I hold it for a month, but usually if I'm taking it, I'm looking for it as a trade. When you hear people on TV say, I'm taking it for a trade, what they're saying is, I'm not buying it and planning on holding it as long as the fundamentals are good. When they're taking it for a trade, they're trading technicals, meaning they'll get out, in hours, maybe 3 or 4 days, maybe a week. And that's the difference. When you're taking something for a trade, you're buying at support, you're selling at resistance, or you're buying strong momentum up, you're selling strong momentum down. You're ignoring fundamentals. You're just looking for a fast money profit. And when I trade VXX, I'm a trader. I'm not an investor. I don't buy it and hold it hoping that it's going to go up forever. I'm buying it with the intention of making, a certain number of percentage points. So, right, in the old days when it was back at, 12, I would try to hold for, $2, for example, about $2. Sometimes I make more, sometimes less, but about $2, so a 20% move. And that means now that it's up at 50, that means if I'm trading it, I'm going to be going for, maybe a 5 or 10% or $5 or $10 move. Okay, if you were swing trading longs, where would you decide it's time to exit? Okay, depends on where you're talking about entering. If you're entering here, you got to get out here. You have your 4 points. If you bought above here, I would get out here or on the third bear close. Once I see the third bear close and a possible 2-leg trap in a bear channel or a trading range, I'm going to get out. Okay, where would you decide it's time to exit? Bar 47 to 51. Yeah, to me, 3 bear bars, that's usually my my time to exit if I do not exit on the failed breakout. If you buy above 19, okay, if you buy above 19, is it better to scale in at 1-point intervals or wait to buy above a bull bar? If I buy above 19, I'm buying a double bottom bull flag. I'm going to probably put a tight stop below 19. For me, I might take one buy down. To me, it should not fall below 19 if it's good, especially since we have a double top and a bear bar here, and therefore I'm hesitant. I'll be fairly quick to get out. So for me, I would get out below 19. If I instead bought more 1 point lower, I would either get out below 19, or if I'm trading really small, I would wait for a bull bar and buy more, like above 26 or 27. And then when it gets back up to that area, you get out break even. You can see it never got back to the 19 high. In that kind of a situation, if you bought above 19, used a wide stop and bought more here, and it got very close to your target and then had a bear bar, I usually get out on the reversal down. So had I bought above 19 and bought more here, and we got close to my original buy here, but not all the way to it, and I got a bear bar, I would get out below that low. Question, I was holding long bar 56. Can you talk about trade management? That's actually tricky. A lot of times you get these second leg traps and they'll fall below the buy climax low, but not below the bull trend low. And you're starting to run out of time. But had I bought that, I would have gotten out on the third bear close or above a bull bar 52 after 5 bars down and just taking the loss. The alternative is to put a stop all the way down here, betting that we're not going down to a new low of the day. And then you have to manage it. So you buy, you would have ended up with a loss, right? So if you buy that close, you buy more above a bull bar. Okay. You needed the market to get back one tick above that to get out break even, and it did not. And a lot of the bulls probably got out below 72. It got close to the target, a bear bar, they'll get out below. That's probably part of the reason why we sold off at 72. The scale-in bulls gave up. They tried to get there, could not, tried to get there, could not, tried to get there, and got within a couple ticks. And a lot of the bulls got out below 72. Okay, I'm losing my voice. Okay. I still think this looks like a head and shoulders bottom. It looks like a big bull flag, but we may go a little bit lower. So strong reversal up. We may go a little bit lower. We've got this gap down here. Maybe we'll get into the gap. I still think it's more that we're going to go higher, but I also think that we're going to fail around this high or below that high, and then break below here, the wedge bottom on the daily chart, and get a measured move down to the 2350 area, maybe 2300. So the next several weeks can be very interesting. There are several Federal Reserve boards making interest rate decisions in September. And no one's talking about, they're going to do something surprisingly good leading to a huge rally. That's not what people are talking about. People are saying they'll either do something neutral and the market will continue as it's doing and grind higher, or they'll do something terrible and the market will sell off. So we have the potential for a big move down. Whenever there's potential for a big move down and not much potential for a big move up, there's always a higher potential for a big move up than what there appears to be. I think down is more likely, but we'll see. Hope everybody has a good night.